Brought to you by
Palm Marina Estates, Garuga, where luxury meets lifestyle by the water.
We all want to own a piece of this city, but the cultural rule in Uganda has always been save 100% cash and build slowly in phases. But in a fast-moving market, saving in cash while property prices appreciate means you are chasing a target that keeps running away from you. Today we are breaking down the hard math of mortgages, true affordability, and how to safely use other people's money to build your own wealth without losing sleep. Let's look at the real numbers. The Bank of Uganda has held the central rate steady at 9.75%. But by the time the commercial banks add their risk premiums, the actual lending rate you and I get hit with averages around 18.7%. Over a 15-year loan, you're practically paying back double the value of the house. That is the hard truth. Plus, the banks will only finance up to 80 or 85% of the value. You must bring 20% hard cash as skin in the game. Don't forget the hidden stack, either bank processing fees, legal fees, and valuation costs can collapse your plan before you even sign. To win, you use aggressive principal pay downs. Throw any cash windfall bonuses, side hustle cash directly into the principal balance. Shaving just 30 million off what you owe in year 3 can cut down 5 years of compounding interest off your lifetime loan. But don't take my word for it. Let's put the lenders in the hot seat and get some straight answers for your wallet. Joining me is Harold from Housing Finance Bank. Hi Harold, welcome to the show.
Thank you so much.
We'll start it right away, Harold.
Yes.
For a person earning 3 million shillings, it feels absolutely unrealistic to walk into the bank for a mortgage. Practically, what can they afford without straining their family?
All right. First of all, at Housing Finance Bank, we are driven by the purpose that we finance a sustainable future for all.
Yes.
What am I trying to say? The question is, what can you afford as opposed to what you qualify for? Well, as you can actually walk in and arbitrarily, okay, by default, take it or leave it, I can say 120 million, 90 million, probably 120 if you're borrowing for a longer period. If you're going for probably 10 years and above, then I would say at a micro level, probably 30 million because you're looking at 3 years. But what is most important is what can you afford as a person? Well, we would want a scenario whereby we create a scenario of somebody who is cash rich as well, not only house rich. Because you can be house rich, yes, you have a mortgage, but like you said, you can't afford fees for your kids. Where is that going to take you? If inevitably the fees will eat into the what? The school fees will eat into the mortgage payments. So to answer you is that one, we look out for affordability. You should be able to afford it. You should be able to pay your fees. You should be able to possibly pay your rent if you're not buying outrightly. Because if you're not buying outrightly, you still have to pay what? Rent. You have to pay rent and you have to pay monthly. Exactly. So you have to feed. So there should be a smart ceiling at that point. You should be able to promote your livelihood properly, people living happily, such that you feed your family and also pay the mortgage. But the beauty is that with Housing Finance Bank, we have different facilities that actually can support that. You can go long term if you're probably a salary earner. It's still okay. You'll get probably up to 120 million. We'll try and ensure that we don't go beyond 50% of your earnings.
That's what I was going to ask. That out of my 3 million, what should go towards my
we should
mortgage?
not go beyond 50% of your earnings, because at the end of the day, the expectation is you still have to what? To survive. For somebody in business, we'll do the same concept. We don't go beyond that buffer, so that you have a room to play with in case of any eventualities.
Many viewers are scared of the word variable interest payments.
Yes.
Now, because they think the bank can wake up overnight and increase their loan installment because the economic times have shifted. How practically do you protect buyers and how can buyers protect themselves against such fluctuations in interest rates?
Thank you so much. One, to the viewers, I want to confirm that the bank doesn't work up in a fortnight arbitrarily and increases interest rates. It's driven by so many factors, probably economic demands, and so many factors in the world that would actually, maybe they're affecting the economy, and the bank has no choice but to increase your interest rate. But however, that is also, at the time of acquiring the facility, it's in your mortgage document, something they explain to you, because we are supposed to be transparent. We are regulated by Bank of Uganda, so you'll have that information. But on the side of the borrower, what do I expect? Is that as you're borrowing, it's better to plan well, keep a buffer. then why are you depleting all your earnings to probably pay over 40 and above percent? So if you're doing anything above 40% or 50%, in case there's an increment, you'll definitely be hit. So but if you're within those margins, it will not be difficult for you to manage that slight increment.
Harold, let's face the reality of a normal Ugandan. Many are in the informal sector. Yes, they have raw cash coming in, but not for more paperwork or corporate jobs. How can such a hustler prove to you that they can actually afford a home loan?
And that is the most interesting story. That is the typical informal sector. And I can tell you, you'd say over 70% of Ugandans belong there. Because we're employed in the informal sector. So we can't disregard them. They can't be what? Banked. Usually what happens is that there are so many things we do. First of all, it starts with you painting a credible cash flow story.
A credible cash flow story.
What do I mean? We'll have interactions. You get my point. There are scenarios whereby you say, is in informal sector, but maybe is registered as a business license, is a sole proprietor. You have a document to work with, but most of them will have a trading license. And they work somewhere and they are hustling and they are making the what? They are making the money.
The income.
So what do we look at? We look at, there are several avenues. Most people actually have embraced mobile money. You'll see some of them doing transactions on mobile money. Some of them have bank accounts, but also sometimes bank with agents because you realize that they want to bank on somebody next door. Some of them are involved in circles. They have that small passbook they can give you and you actually look at what? Their bankings, probably to tell you how much they're doing in terms of sales and in terms of what? Savings. If they don't have that, doesn't mean they're not what? Bankable. That's why I say paint a credible cash flow story. We send to your officers, they will come to you, you will tell them actually you earn, because usually a borrower knows how they make their money.
Yes, they do.
Of course, we check the credibility of that information. That's why we come to your premises, we're able to see the visibility of the premises. You can't tell me you're doing sales of 50 million when actually your stock is 2 million. It's practically impossible.
A mortgage is just a financial tool with a specific price tag. Understand the frictional costs. Protect your 35% debt to income ratio and make time work for you. For Property 360, master the math and keep building bold. See you on the next block.